Hello everyone, let us continue with our discussion. So in the previous lecture, we have discussed in detail about the business cycle and the inflation. Clear? Now in this session, I am taking the things ahead towards the cash flows as well as the fiscal policy, which tells how much investments, how much infrastructure, how much cash will come from the side of the government in the hands of the public. Clear? So monetary policy comes from the central bank of the country and fiscal policy comes from the government. Clear? So the point of discussion over here is this: how the governments and central banks can influence the economy. Clear? So how these actions are connected with the business cycle and how the yield curve will predict the economic condition. So means again we are coming back to the business cycle, that how these central banks or government action will influence your business cycle as well as the yield curve, and the motive is to predict the future economic condition. Clear? So we will start with the monetary policy and the business cycle. Clear? So monetary policy means what? Actions which are taken by the central bank, like RBI in India, Federal Reserve in US. So what they control? They control three major things. One is your interest rates. Second is the money supply, and third one is credit availability. These are the three things which they do control. Now why the central bank do this? So basically their purpose is to keep the economy stable, neither too high inflation nor we will reach towards the recession. Clear? Now business cycle, we have discussed the stages: expansion, peak, contraction, recession, and then recovery. Clear? Expansion means economy is growing, peak means growth is very high, inflation is rising, recession, growth slow down, and then again economy will start improving, the reviving. Clear? So what monetary policy tries to do? It tries to smoothen this particular cycle. Clear? So central bank use counter cyclical policy. What is the meaning of counter cyclical? Opposite of the business cycle. Opposite of the business cycle means if economy is slowing down, if the economy is coming down, so what central bank will do? They will reduce the interest rate. We call this as a stimulative policy. When the interest rates are low, businesses, houses, they will start borrowing the money, they will start doing the business, employment, money in the hands of the public, economy will start reviving. When economy is overheated, clear, huge inflation, central bank will increase the interest rate. Now I cannot borrow the money, I cannot do the business, employment will reduce, and hence economy will again become stable. Like when COVID hit, what RBI did? They reduced the interest rate so that people can take more home loans, car loans, companies can borrow easily and continue the operations, and economy can stay alive, because economy will be alive only with the flow of the money. So we call this as a counter cyclical support during the recession. Counter cyclical support during the recession. So you can see that I mentioned it in the first point. What is the goal? That we need to balance the price stability, also the economic growth. Late expansion means your inflation is rising, so we will put the restrictive policy. Clear? And it leads to the recession. Clear? Expansionary policies means what? You will reduce the interest rate, consumer spending will increase, business investments will increase, stocks and bond price will increase, domestic currency will reduce, and hence export will also increase. Are you clear? Now the question is how this interest rate actually help the economy. See, when interest rates are low, EMI will become cheaper, people will spend more, companies will borrow and invest more, stock price is rising. Cheap loans means what? Companies profits are also rising, profits will rise, stock price will also rise, bond price will also rise, because interest are low, bond price will also increase, and hence the value of the assets is increasing. Clear? Company value falls when, sorry, currency value falls when your currency value is becoming less and less. Exports will become cheaper, benefit to the exporter aim to export more and more. Clear? Suppose your home loan EMI drops from 20,000 to 15,000. So suddenly now you got 5,000 rupees extra every month. So what you will do? You spend more, you will shop more, leads to the growth of the economy. Clear? There is one more concept. The concept is of the neutral interest rate, means the interest rate at which the economy will grow normally without causing the inflation or recession. Clear? So neutral rates will include your inflation component, real growth component, and the judgment by the policy maker. So over here you can see that if my inflation target is 3%, real growth expected is 2%, then what is my neutral rate? 5%, 3% inflation target, 2% is my growth target. What is my neutral rate? As simple as that, 5%. Clear? So this is like the normal temperature of the body. If the temperature goes above or below, there is a problem. So better we should keep it normal. Clear? Another point we have is the Taylor's rule. Taylor's rules means how central bank should set the rates, interest rate. Okay. So this Taylor rule depends upon few elements. Okay. What are those elements? Element number one is your neutral rate. This is your first element, neutral rates. Clear? Second is GDP versus the long-term trend. Clear? How is your GDP related to the trend? And third one is your expected inflation versus the target inflation. Clear? I'll explain you one by one. Don't worry. Now, assume it like this, that if inflation is too high, means you have targeted that inflation in your country should be restricted to 4%, but right now this is 7%. So now the Taylor rule will advise you that you should increase the interest rate, and when you will increase the interest rate, the inflation will come back to the normal 4%. Clear? Like if economy is slowing, then Taylor rule will advise lower the interest rate. So the point is, I need to balance the growth with the inflation. So if inflation is greater than the target, rate rises. If inflation trend versus the growth, then cut down the rates. Means if we are coming towards the recession, then you should cut down the rates. Are you clear? Now coming towards the next point, that is your negative interest rate. It's strange, but it's real. Basically, when you're keeping your money into the bank, now bank is paying you. This is the first concept. Generally it happens normally, but few countries like Japan, okay, they have the negative interest rate earlier. So when I am keeping my money into the bank, I have to pay the bank that please keep my money and keep my money safe. Clear? So normally banks will pay you interest, but here you are paying the interest. Clear? So before 2008, people believe that negative rates are impossible because people would withdraw the cash rather than storing it. Clear? And in that situation, bank will run out of the money, but this never happened. Why? Because of the modern economy need the digital payments first. Second, people prefer banks for larger transaction. So storing the cash is little risky. So even because of the negative interest rate, we are keeping our money to the bank. Three reasons: storing the cash is risky, I prefer bank for larger transaction, and modern economy, they need the digital payments. Clear? So it's not only about Japan. Switzerland also have the similar situations. Denmark also have negative interest rate to stimulate the spending. Clear? So why this is happening? Because the crisis made the economy too weak, and even keeping 0% interest rate would not help. I want to revive my economy. I have reduced the interest rate from 4 to 3, 3 to 2, 2 to 1, even 0 I did. Still it's not helping. Then I kept the interest rate -1. So if you'll borrow money from me, I'll give you something too. Are you understanding? So we have used these type of stimulus to revive our economy. Clear? So risk-free interest rate can become negative. Answer is yes. Clear? Because you are giving the negative interest rate. Clear? Expected returns will become unclear now. It's very hard to use the historical data because these are very rare situations. Negative interest rate is a rare situation. So my business environment will become unpredictable. Clear? So over here, rather than using the data or models or econometric models, they rely more on the judgments. They rely more on the scenarios to forecast the future. Clear? The whole thing I have mentioned it over here. Now you will have these notes. Okay, so if you want, you can pause it and read it, or else you can move ahead because I have explained the all points. Now coming to the fiscal policy and business cycle. Till now I have worked on monetary policy. Now coming to the fiscal policy and the business cycle. Now what is this fiscal policy is? Fiscal policy means government spendings and the taxation. Clear? So they will use, if they want to revive the economy, they have two tools. One is the taxation, another one is the government spending. Clear? So if they want to make the fiscal policy loose, they want to stimulate the economy, they want to grow the economy, what they will do? They will reduce the taxes, they will increase the spendings, deficits will increase, and hence the economy will grow. This is the first point. Again, I'm saying you want to keep the expansionary fiscal policy, reduce your taxes, increase your spendings, deficits will increase, economy will grow. But if you want to contract, restrictive, clear, increase the taxation, people will don't have the money in their hands, spendings will reduce, inflation will also reduce, economy will slow down. Clear? So it's up to the scenario, what is the need of the hour, that's important. Clear? So you can see that two key principles I have added. So see that it is not the deficit level that stimulate the economy. Okay, it is the change in the deficit. Like if deficit stays at 5 lakh crores per year, no impact. But if deficits will increase 5 lakh crore to 10 crore per year, strong stimulus. Okay, means you have invested huge amount of money on infrastructure, you have borrowed the money, or you have utilized, suppose you have 10 lakh crores from taxation, but you have spent 12 lakh crores. Definitely you have to borrow extra 2 lakh crores and you have spent a huge amount of money, your economy will start reviving. Clear? Now coming to the next point, that is your yield curve interpretation. Basically you want to predict the economy with the help of the yield curve. What is yield curve? Interest rate versus the maturity of the bond. Interest rate versus the maturity of the bond. So I need to understand the relationship between the interest rate and the maturity of the bonds. So normal yield curve slope upward because the long term money has higher uncertainty and hence the interest rate is also higher. We have studied this a lot previously, but the shape will change with respect to the policies. Clear? So now I have three different types of policies. One policy is stimulative, reviving the economy. So monetary policy will loosen up, fiscal policy will loosen up, yield curve will become steep, higher interest rates in the long run. Clear? Economy expected to grow because over here your interest rates are less. You want to revive the economy. So RBI will cut the interest rate, government spendings will increase, short term rates will decrease, but long term rates will increase a lot. Say current situation like this, current situation after the policies, situations like this, short term interest rate decreased, long term interest rate increased. Clear? So it's more of a steep curve. When policies are restrictive, yield curve will become inverted, means it will turn it like this. In the short term they will increase the interest rate and in the long run they will decrease the interest rate. That will predict the recession. Clear? So central bank will increase the interest rate aggressively. Short term bonds rate are going to be of very high interest rate and in the long run interest rate will come down. Clear? Now when policies conflict with each other, means monetary policy is tight but fiscal policy is loose. In that situation, monetary policy is tight, fiscal policy is loose, you will see a flat curve. Clear? Monetary policy is loose, fiscal policy is tight, you will see moderate steep, not very steep, moderate steep. Clear? In the first situation, when monetary policy is tight, fiscal policy is loose, impact is uncertain on the economy. Clear? And the second situation also, the impact is unclear, how it is going to impact, in what manner. Clear? So these two situations, monetary policy and fiscal policy, it has been said that they should move in the same direction, on the same path. Clear? So with this, you can see that I have mentioned yield curve and business cycle. Clear? If you are at the bottom of the cycle, you will see that it is going to be steep expansion, it will flatten up. When we are at the peak, then it will become flat to inverted. Okay, we are going to come down. We have to strict ourselves. We have to increase the interest rate in the short run. Clear? And during the recession, re-steepen, but like this, upward. Okay, upward rising, because in the short run interest rate is low, in the long run interest rate is going to be rising. Now coming to the next point, that is international macroeconomic linkage. So now coming and moving ahead from my country to the globe, because it's okay, you identify your own interest rate, your own inflation, your own import export currency is fine, but when you're moving ahead, you have to look for the global level. So the first point to be discussed over here is the flow of the trade, the business which you are doing from other countries, and the flow of the money between countries. Clear? So when I'm using the word first, globalization means higher interdependence between the economy. My economy is dependent upon the US, my economy is dependent upon European countries, Middle East country is dependent upon us because we purchase the oil from them. So economies are now interdependent on each other. We call this as a globalization. Clear? So over here, what we are going to discuss about trade, capital flow, interest rate, and currency exchange rate. These four are the important factors when you're looking yourself from the global perspective. Clear? Trade linkage. If Europe will slow down, then Indian exporters will suffer, India will slow down. Are you see? There is a slowdown in the Europe. Now Europe will don't call India, please send me the goods. They will not. Indian exporter will suffer, our profits will reduce, India will slow down. Trade linkage between the country and how one country's recession will bring the recession in India. Can you see that? Capital flow. Capital flow means currency depreciation. So if foreign investors pulling the money out from your country, it leads to your country depreciation, stock market will fall, bond yield will increase. These are the three outcome when foreign investors will put their money out. If you wish, you can take the note down. Number one, currency depreciation, stock market will start falling. Third, bond market, you will see the rise in the yield. Clear? Third is current account and capital account. Clear? So if we move opposite, basically if current account, if you will see there is a surplus in the current account, then capital account will be a deficit, and if current account deficit is there, you will see capital account is at surplus. Like I'll give you one example. If India will import more than export, clear, money will flow outside India. Clear? Now India must attract foreign investments, because if money is going out, I have to bring that money from somewhere. Then investments is coming from outside. Clear? And this investment is called as capital account surplus. Capital account surplus. So your current account is deficit. Why? Because your import is more than your export. So current account deficit. Clear? Currently your import is more than the export, the more money you are putting outside. So now that money needs to be balanced from the capital account surplus, means investment is coming from outside and balancing that gap. Clear? Currency pegging. This one. See, some countries will fix their currency to a bigger country currency. Like Hong Kong dollars, they are pegged to the US dollar. Clear? So what will happen? Generally, small countries will follow the big country interest rate. So investors will lose the country. Then small country must raise the interest rate to protect the currency. Clear? So when you are pegged, you have to follow the other nation's policy. Clear? But you are not pegged. Suppose India is not pegged to anyone else. So if I want to attract more foreign investments, what will I do? What will I do? In a simpler terms, I will increase the interest rate. So now if an investor who is sitting in the US, okay, what he will see that in US interest rate is 2%, but in India is offering 8%. So what he'll do, he will come and invest in India and he will put the money in India. Clear? So this is how I can bring the money in our country, and hence the currency will be overvalued. Clear? Now there is one more point, when your currency is pegged to some other country. Clear? Now you see that suppose Hong Kong and USD, okay, they are pegged to USD. So now what's happening, the interest rate, if you look at the interest rate, suppose in US interest rate is 4%, in Hong Kong it is 3%, very minute difference, confidence is high. Clear? But if suppose this difference is huge, 4%, 1%, that means confidence is low and there is a high risk premium. That's why the interest rate is low over here or interest rate is high over there. Are you clear? When the difference is high, that means one side you will find that there is a high risk premium because of the low confidence in that particular country. Clear? And when you are without pegging, what you will do, you will increase your interest rate, foreign investments will come, you will get the money, strong economic activities, but higher bond yields because you have increased the interest rate. Global saving and investment, the interest rate tends to move together, means your investment is increasing, economy is also increasing, GDP is also increasing. So interest rate is increasing along with the interest rate. So they both are moving together. Clear? Now to summarize all, in this lecture I have mentioned in these 7 points. Clear? Monetary policy is counter cyclical. Clear? Taylor rules, which we have discussed, negative interest rate, we have discussed the fiscal stimulus depends upon the change in the deficits, business cycle convergence, currency peg will create the strong economic policy linkage. So they all are going to help each other. Clear? So I have kept this 6 point for the quick revision of what we have studied in this particular topic. Okay, so I am keeping this much in this lecture and we are done with this. Okay, thank you.